Dean, thank you. The cost of college continues to climb, in a surprise to nobody. Interest rates for millions of student loans will go up tomorrow, July 1st, and the timing couldn't be worse. The class of 2014 just graduated as the most indebted in history. Jeff Cutter from Cutter Financial Group joins me now to talk about why the rates are going up now, what we can expect in the future, and potentially some steps that you should take to pay off your student loans. Thanks for being with us.
A pleasure.
Not great news for people that are thinking, you know, they're heading off to college maybe in the fall or maybe thinking about it in the next couple of years, and they know that they're going to have to take out loans. First question is, what kind of a rise are we talking here?
So here's what we know. Our kids are strapped with $1.2 trillion in debt. All right. Just here in Massachusetts, the average student is coming out of college with about $30,000 in debt. Now, what this does to our economy, it puts off the progression of these folks. So these kids are coming out and they're not getting married, they're not having children, they're not buying homes. It puts a real drag on our economy. What we know, though, is that for every $10,000 of college debt, it's going to increase their expenses by about $50. And it's not going to get any easier because the Congress last year put together a plan tying the interest rates of the student loans to the Treasury notes. So the question we have to ask ourselves is there more risk of interest rates going up in the future as opposed to going down? And of course, it's going up.
So with these kids that are potentially getting ready to take out these loans, I mean, what can they do? Are they just sort of staring in the face of this raise in loan rates and there's nothing they can do about it?
Yeah, unfortunately, our kids right now are the most indebted to the student loans that we've ever had. Right now, there's certain steps that once we get out of school that we can take to try to minimize the overall, you know, our exposure and our risk to this. But unfortunately, with the way that the Congress has put together the plans, interest rates will be tied to Treasury notes.
And by the way, I mean, you just mentioned before it goes up by $50, which may not sound like a lot to a lot of people, but when you're a kid and you've just gotten out of college, $50 is like maybe what you would spend on groceries in a week. So it's a ton of money for people that...
It actually is, and there was actually a study that was just brought out by the Huffington Post that says of the kids who have jobs, okay, because many of them don't, but of the kids who have jobs, half of them have jobs that you don't even need a college education for. Yeah. So our kids are overly educated and underemployed.
I believe it. And you take the job just because it's a start. You need some money, and then you hope to build from there.
That's
but
right.
You do what you got to do to pay whatever bills you have.
That's
okay,
right.
So let's go through. I know you have some tips for some of these kids. First one is understand your debt.
It sounds easy, right? But what happens is the kids have debts with all different companies, right? So what we tell them to do is take a financial inventory of their loans, know where the loans are. Because what we know is that 15% of our kids within the first 3 years are going to default on their loans. What I did for today was on our website, if you go to the resource tab, there's a link there to help these kids, okay, go to the national database for student loans, and they can understand where their loans are.
Okay. Delay your repayment. That's an option still.
Yeah, it is. It is. Many of these loan companies will allow you to defer your payments, okay, until that you get a job.
Is that income sensitive too? If you have a job, but maybe you're not making so much money, or can you still defer?
You may not be able to defer, but you are right. It is based upon income. So what they'll often do is actually take the payments and make them lower.
Prioritize your loans here. As you mentioned, people obviously, car payments, other things. Where does the student loan, if you had to pay one and you can't pay the others, what do you pay?
Yeah, same way that we tell our clients who are pre-retired and retired, the more we plan, the more we accomplish. So when we build a debt plan, what we want to do is look at all of our loans and then make the minimum payments on all of them. But the ones who have the highest interest rate, what we want to do is put more towards the principal there, because what will happen is slowly but surely through discipline and some hardship, we can pay off those loans.
It happens. We've all been there. Some of us are still there, even after all these years.
It's true, though.
It is. It's a huge undertaking, and it can be intimidating. So, Jeff Cutter, we appreciate you sharing some of your expertise with us.
A pleasure. Happy 4th.
We're going to take a break here on the Fox 25 Morning News. We'll be back after this.